Stocks recorded a second week of solid gains as investors seem to grow more confident about the containment of the new coronavirus, officially designated on Wednesday as COVID-19. The gains brought the large cap indexes and the Nasdaq Composite Index to record highs, with the latter receiving an extra boost from the continued strong performance of technology stocks. T. Rowe Price traders noted that trading volumes trailed off considerably earlier in the week, however, hitting year-to-date lows on Monday. The small real estate sector outperformed within the S&P 500 index, helped by strong gains in the shares of cellular tower operators. Consumer staples shares lagged. Some encouraging data on the stabilization in COVID-19 infections helped spur gains for much of the week, before a jump in reported cases on Thursday seemed to cause a pullback. Investors also seemed reassured by Federal Reserve Chair Jerome Powell's congressional testimony on Tuesday and Wednesday, in which he indicated that the policymakers were closely monitoring the spread of the virus. While Powell also remarked that it was just too early to say how the global economy would be affected, a consensus seemed to grow that the Fed would cut rates in the coming months. By Friday, according to CME Group data, investors were pricing in a high 82% chance of a federal funds rate cut in 2020, with approximately an almost equal 46% chance of 2 cuts or more. The Fed's announcement Thursday that it was shrinking the size of its purchases of Treasury bills to support the so-called repo market for short-term lending seemed to derail the day's rally, however. The focus on the virus may have taken the spotlight off some other important and potentially negative developments on the U.S.-China trade front. On Monday, the Department of Justice indicted 4 members of the Chinese military for their alleged role in stealing data from credit reporting firm Equifax in 2017. On Thursday, the DOJ announced a racketeering investigation into Chinese telecom giant Huawei Technologies for allegedly engaging in stealing intellectual property from U.S. firms. The week's economic signals were mixed, particularly on the labor front. On Tuesday, the Labor Department reported that job openings had fallen sharply in December and reached their lowest level in 2 years. Weekly jobless claims, reported Thursday, remained near multi-decade lows, however. Friday brought news that retail sales had expanded a respectable 0.3% in January, but industrial production had declined for the second consecutive month. Boeing's shutdown of its 737 MAX airliner production and the impact of COVID-19 on supply chains are leading many economists to push back their expectations for a recovery in the U.S. manufacturing sector. European shares rose to record highs as coronavirus fears waned, but they lost steam at the end of the week on news of a sizable increase in cases in China. The Pan-European Stocks Europe 600 index ended the week 1.43% higher, while Germany's Xetra DAX index rose 1.69% and France's CAC 40 index gained 0.69%. The UK's FTSE 100 index was little changed. Eurozone economic growth slowed as expected in the fourth quarter of 2019 due to contractions in France and Italy. The economy of the 19 countries expanded 0.1% on the quarter from 0.3% in the previous 3 months, and rose 0.9% on the year, revised down slightly from an earlier estimate. France's gross domestic product shrank 0.1% and Italy's contracted 0.3% in the fourth quarter. Germany and the UK both stagnated, although annual growth rates in both countries were stronger than expected. In Germany, some previous quarters were revised higher, while in the UK, construction and services benefited from a Boris bounce. Japanese stocks drifted lower in the holiday-shortened trading week. The Japanese equity markets were closed on Tuesday for National Founding Day. The Nikkei 225 stock average declined 140 points, or 0.6% for the week, and closed at 23,687.59. The widely watched stock market barometer remained in positive territory for the year to date, however. The large cap Topix index and the Topix small index also logged weekly losses, but both broader market yardsticks are underwater for the year to date. The yen stood at 109.90 per US dollar on Friday. The first estimate of Japan's GDP growth for the final quarter of 2019 is scheduled for release on Monday, February 17th. Most economists believe that the Japanese economy contracted about 4% in the period, largely due to the October 1st consumption tax hike, the slowdown in global growth, and weather factors, including typhoons. The outlook for current quarter GDP growth is also looking less robust than earlier projections. The COVID-19 outbreak has dented consumer sentiment, travel and tourism, and hurt manufacturers because of supply chain disruptions. While most forecasters expect the long-term impact from the outbreak to be modest, the Bank of Japan has forecast positive GDP growth in each of the coming 3 fiscal years. Back-to-back quarterly contractions meet the technical definition of recession. That's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.